Okay, what's up, everyone? How are you all today? I hope you're very good today. I'm feeling not bad. But okay, so today I've with me my brother. Obviously, I don't think we look that alike, but you say whatever you want. Let us know in the comments if you think we do. I've actually never ever had it before. Have you ever had anyone say, "Whoa, you guys are look alike, like you guys look like brothers"?
I don't think so, no.
Yeah, I don't think we look alike. Like you're taller than me, I'm shorter, I look different, blah blah blah.
Yeah, a lot of dissimilarities.
Yeah, and like personality wise, we're also like quite a bit different as well. You're very, I don't know, who cares? We don't need to explain the differences, but yeah. Uh, so yeah, this is my brother. His name is Lee Cooper, same last name, surprisingly. Who would have thought? And guys, I'm gonna explain to you why I've got my brother on this channel. So essentially, 2 years ago, whatever, you tell me how wrong I am if you want. But I think it was 2 years ago, you got really into value investing. You went on this like 3 week retreat or something. All you did was read Warren Buffett's shareholder letters and you
Yes,
basically studied value investing like a psychopath. Um,
yes.
and you've kind of been just learning value investing since then. And you told me this, I don't know, a week ago or whatever, but you said that every year for 2 weeks, you spend 2 weeks going hard trying to find a value stock on the market. You try to go through basically every stock you can. You filter out some stocks that you know won't be in there, but you go through every stock to try find this value play. And you did that, I don't know when. I think it might have been start of this
January,
year, January,
January or February this year was my last one.
January, February this year, 2 weeks trying to find this value stock. And he found this stock that we're going to be talking about in this video. And so Lee's gonna explain why he likes the stock, what he sees in it, and then he wants some feedback and to see if you see any holes in the proposition, and if you see the stock might not be a value play at all, and it's got something completely wrong with it. But as far as he can tell, I don't think you can see any holes in it, right?
Yeah, I think for me it would be helpful definitely to have other people go over it and look for flaws in my reasoning. But yeah, so far I'm quite hopeful. Everything's looking like really good.
Yeah. So guys, if you want, if you're looking for a value play, which why would you not be? Everyone wants to find a deal in the stock market, right? Spend some time and listen to his thesis, and then tell us what you think after you've done your own thesis.
So small cap, well, the name of the company, Gravity.co, Gravity Company Limited or something. It's a South Korean games company. Um, yeah, small cap. I think it's around a market cap of 280 million. So,
Yeah.
I mean, a lot of like the big hedge funds and those investors will probably not be involved in it. And like just like a quick TLDR on what they do is they create games, like mobile and computer games. And mostly they sell them in Southeast Asia, but they do sell like a few in America and like the Western world. And they used to have one game that they started with. I think it was called Thor Ragnarok or something like this. 2002 is when they started, and it's like one of those slow growing games where it's just like it's kind of like growing just slowly through a long period of time, and that's a big portion of their revenue still.
Okay, so that one game that they initially made has just grown slowly in popularity. It didn't kind of just blast off out of nowhere and get a
Yeah,
big
because
following.
it's a bit of a weird thing for games when
Yeah,
they
yeah.
grow. That's like Minecraft is another example for that. It's like been around for ages, but
Yeah.
yeah, it's not like a lot of games will just like wither and die after
Mm.
like 20 years, right? But Minecraft, for example, it's just growing slowly and same with this one.
That is interesting. I guess the positive about that would be that if, as what history shows us, it has grown slowly in the past. So, and it's been consistent. So that means in a way you can extrapolate that into the future, and it may be more consistent compared to a lot of other games that blow off at the start and then die down after nothing.
Yes. Yes, exactly.
So as a business owner looking at the business model, this is not the worst thing.
Yes. The recently, I mean, we'll go through like the financials, but over the last like 3 or 4 years, it has like the revenue has increased quite a bit. Um, I think the revenue from that game has increased quite a bit. Which again, like that could mean also that the revenue might go back down because it hasn't just been like exactly gradual growth. It's been like slow, slow, slow. And in the last few years, it's been like up a bit.
Okay.
Who knows what could happen next?
Yeah. And so it's not just obviously one game, you're telling me earlier on, because we've discussed this before, but you said like they have spun off a lot of games of this Ragnarok.
Yeah, exactly. So that's what they're doing now. They've got, I won't say the number because I actually don't know it, but they've got like a lot of employees. And
Yeah.
basically what they'll do is they'll create new mobile games. In general, mobile games last for about 18 months in terms of revenue from release date. And they'll just spin off like a bunch of mobile games in the Jeff Bezos throw stuff at the wall and see what sticks fashion. And every now and then something sticks. And over the last few years, a few games have stuck, and the revenue it's improved a lot.
I guess that's like a key way to see if the games have actually been sticking, is looking at the revenue. And
True, true.
And we'll look at the revenue soon, but it has been pretty consistent from what I checked up on. So what I was actually thinking was, if we have some nerdy Ragnarok gamer out there, guys, give us some insight about this game. Like, how popular is it right now? And especially the most important thing is extrapolating it into the future. Do you think it's just going to continue like it has done it for the past 20 years? So any nerdy gamer out there, let us know. But so, okay, first of all, just off the bat, what attracted to you with the stock?
So, like, yeah, the way I normally screen stocks is generally I'll have a quick look through their financial statements. I'll look at the main two things I want to look at is net income and cash flow, and I'm also just kind of looking. I mean, if I do see something where the net income and cash flow are both good relative to the price, i.e., P to E ratio, looks good, then I also look to make sure that it's not just like a 1 year spike in profit, which happens a lot. So like this one, for example, I noticed, okay, have a look at this. It's got like a crazy good PE ratio. We'll go through in a second and look at the numbers. It's got a crazy good PE ratio. The earnings have actually been like increasing over the last few years. It's not like a crazy spike over the last year. It's actually been like quite consistent growth. And then the one last thing that looked really good for it was that even not only did it have a crazy good PE ratio, like i.e. Like cash flow to market cap, but it actually also had like a significant portion of savings in the bank, like a crazy portion of their market cap was just sitting there in the bank. It didn't have any liabilities to offset it, right? So it's basically just you're buying a business. It's got a bunch of cash in the bank, not much liabilities. Essentially, if you're doing your valuation for that, you can say, you can take that off the market cap. You can say it costs 280 million, but it's just got 280 million. It's 200 million cash sitting inside. So therefore, I'm going to really pay about 80 mil for it.
It's like I just came up with this analogy in my head literally 10 seconds ago while you're talking. Like, if you bought an apartment for, let's say, $100,000, and in that apartment, it's just got $80,000 of cash in it. So how much have you actually bought that apartment for? $20,000, right? 100,000 minus 80. You just get this cash. It's just sitting there once you buy the business.
A very good analogy. Yeah, very good analogy.
That just randomly came to my head. I don't think it's too bad. Like, it's pretty understandable, right?
Yeah, it's a very good analogy. Yeah.
Yeah. So basically, looking at the balance sheet, it's got a ton of cash in it. and the liabilities are not that high, and the cash flow is good, the income's good and pretty consistent.
So what do you think we should show them? Show them the numbers we're talking about? Or?
Yeah.
Yeah. So I'll see if I can quickly share my screen with you. So this is the company, Gravity Company Limited. I mean, if any of you are familiar with ticker, you'll know what I'm clicking around on. But for those of you who aren't, I'll just point out like the
ticker's the website you're on.
Ticker's the website. It's basically just like a website for seeing the fundamental.
Yeah, like a different version of Yahoo Finance, put simply.
Exactly. Yeah. Okay, so market cap currently, probably one of the most important pieces of information. How much you're buying the apartment for, in Tristan's analogy, is 275 million. But this weird number here, TEV, and I think it stands for something like total estimated value, is only 78 million. But basically what it's saying is like, if we're buying the apartment for 275 million, and the apartment has around 200 million sitting in the bank, what you're really paying for it is about 78 million. So
the true price, eh? TEV is kind of like the true price.
True price, yeah, exactly. Yeah, true price. It's basically like market cap minus any like liquid assets you have just sitting inside the business.
Yeah.
Not even liquid assets, just like cash or treasuries.
Yeah. So it's like when you buy the apartment, it's how much cash you have that's just sitting in the apartment there.
Exactly.
Yeah.
So, okay. So those two numbers, keep those in mind as you look through.
Yeah.
Those ones are important. Then looking through, I like the first thing I normally do is go income statement. And we've just got here, it's kind of just got the dates, but 2017, 2018, 19, 20, 21. See the last 5 years. You can kind of see like a growth in revenues. Like this growth in revenues, to be honest, is quite recent. Like before 2017, it's not like, it's kind of grown a lot since 2017. Before that, it was like growing much more slowly.
Yeah. So if we just look at that revenue there, if we can go back to that. Yep. So 2017, 132 went up, and it almost doubled the year over year to 2018, 250, kept going up 2019, 300, 2020 kept going up 356. And then 2021, it kind of stayed the same, slightly down 332. And then last 12 months, it went down again slightly to 255. So this is all what we are talking about earlier, how they keep spinning off games. And sometimes the games will do really well over the next 18 months or whatever, but it can be a bit choppy, the revenue. Yeah,
exactly. Basically, this end of this year, we expect a revenue probably slightly less. And then the most important thing to look at after that, I think, is just, I normally scroll straight down to net income.
Yeah.
If you see any like things like revenue's been rising a lot, and then you scroll down to net income and it's not rising, normally just means like their expenses are increasing as well. So you just that's when maybe you would like look into it a little bit, like why is the expenses increasing? What's going on? But for this one, it seems like net income is rising at a similar rate to revenue. So just looking at the net income numbers. Now, keep in mind that this company, you can buy it for 280 million, but really you're only paying like about 80 million for it. 78 million was the exact number. So these are the net income coming in, which is basically what the company is earning in cash for you. So 2017, it got 12 million, then 28 million, 34 million, 57 million, 55 million. And this year, end of this year, probably go down to maybe 35 million.
Yeah, chopped off.
So if you look at that, if you compare it to even 280 million, you're looking pretty good. I think like whatever 100 divided by 6 is like what you would be looking at.
But if you compare it, pardon?
Almost 20, like even if you're comparing it to 280 million, I think it's almost 20%, if my head math there is correct.
Yeah. But you can
But
also
then,
compare it to the terminal, the true value, what we're calling
yeah,
it, eh? That
yeah, exactly. To compare it to the true value, it's looking like ridiculously good, right? It's something it's like in your apartment analogy, you're buying the apartment 280, it's got 200 million cash inside it, and the apartment is earning like 55 million a year. So it's
or 35 million.
or 35, yeah. So
Because
it's earning maybe like almost half of what the true value is, right?
yeah. So that
It's
means
almost like 50%
almost in 2
return.
years, you'd get your money back just through what the business
Yeah,
has
exactly.
earned.
Yeah. Yeah. If you bought the business, you took the cash out the bank, you
Yeah.
waited 2 years and you took the cash from those 2 years, you would have all your money back and you would still own the business.
Yeah.
Yeah. That's quite cool actually. So that was just to basically give you an idea of what the cash flows we're talking about are. I won't confuse you with too many numbers.
Yeah.
Oh, actually, maybe we'll look at the balance sheet quickly just so you can see what we're
We're
talking
talking
about.
about.
Yeah. So we'll look at the most recent one, which is last 12 months. This will be from their most recent report, which was like a few months ago. And so total cash and short-term investments. Now, this basically just means it's sitting in cash or it's in treasury deposits, which is basically as good as cash. 200 million bucks, 200 million bucks sitting there. And then if you look down, one thing I kind of like to look at, I don't want to confuse people, but so the total current assets are 262 million. 200 million of that is cash. So the rest of the current assets, which is just like receivables, mostly like what customers owe you, is about 60 million. And then if you scroll down and you look at total liabilities, right? So all current liabilities and long-term liabilities, basically everything the company owes is about 65 million. So if you take receivables and you can kind of use them to cancel out all the liabilities. So if all the customers give you what they owe, you can pay off all your debts and you still have 200 million sitting in the bank.
Yeah.
So yeah, that's where that 200 million in cash thing sort of comes from. So that's basically the main thing about the balance sheet. And then the one other thing which I normally like to check is that the free cash flow, which is kind of just like another measure of how much money the company has coming in. Normally this should be similar to net profit. If it's not similar to net profit, you need to look into it more because probably the company, even though they're making a profit on the income statement, probably a lot of that profit is being paid into stuff like business depreciation. So they've got to pay for like upkeep of businesses, of building depreciation.
Yeah.
They've got to pay for upkeep of their buildings. So if you ever see free cash flow very low and net profit high, it's basically it's because they're paying a bunch of money for like depreciation and such expenses.
That's
Which means
interesting.
and Jeff Bezos, when he started Amazon, the main metric he focused on was long-term free cash flow. And he told his investors that from the start. He said, basically, the only thing that matters is free cash flow in the long term.
That is actually so interesting because cash
Yeah.
flow is like very, very hard to manipulate from my understanding. It's like this is the actual cash flow we're getting at the end of the day, the actual money we're receiving each year,
Yeah.
each financial year.
Yeah. The cash that's coming into my business minus the cash that's going out.
Yeah. So
Yeah.
arguably the most important metric to look at when studying a stock.
Is cash flow.
Well,
Free
that's
cash
what
flow.
Bezos said. Yeah.
Yeah, I agree it is. Yeah. That's the most important. Yeah, I agree. And if you look at free cash flow here, I mean, it's not exactly the same as net income, but it's close enough. I mean, you can go into it and see why it's slightly different, but it's actually meaningless in this analysis. Like it's negligible. So I just wanted to show you that free cash flow. 2017, it was 23 mil, 31 mil, 22 mil almost, 63 and 60 million. And then it hasn't been calculated for the most recent one, but you know it's going to be a bit lower because the income has dropped.
Yeah, because in 2021, the the net income was 55 million, and then the LTM for for net income was 35 million.
So 55 to 35. You can actually, here's one cool thing about Ticker is you can just click there and it graphs it. So that's the net income.
Yeah.
And
so
we'll do the same with free cash flow. It should, there we go.
So essentially cash flow for the last 12 months, which is the most important because it's what it was currently, it will have dropped off a bit, just like net income did.
Yeah, exactly. Because this was net income in 2021, and then in 2022 it went down to 35, which is roughly where my mouse is. So if you can see that, so that's basically where the black one will be as well. The free cash flow will drop down there. And then, so do you want me to go on to next onto like maybe the discounted cash flow stuff I did for basically just estimating based on these financial statements, what do I estimate the business is worth?
Yeah, that'd be good.
Yep. No more questions about this?
I think that's a really good overview.
Cool. Perfect. So bull case, so I've got 3 spreadsheets here: bear case, medium case, and bull case. I try to keep it as simple as possible, but there is something that needs to be explained. So I will, I'll go ahead and explain it. I've put down here 35, which is basically what we expect to be the net income. The reason I put down net income, it should be free cash flow. I mean, free cash flow is a better measure. I just put net income because from Ticker, we couldn't actually see what the most recent free cash flow was.
We couldn't see the last 12 months.
Yeah, for the last 12 months.
Free cash flow, yeah.
So it's just easier to use net income because we know free cash flow is going to be pretty similar.
Yeah.
Yeah. So for the medium case, I just said like, well, firstly, when I do like discounted cash flow, I just like to do 5 years because I don't think my prediction ability is that good, even for 5 years, but for longer than that, it's not that good at all. So I just predicted for the next 5 years, 23, 24, 25, 26, 27. For the medium case, I just sort of said, they're going to keep creating new mobile games. I can't see any reason why their big game is going to drop off or increase. Let's just say it stays around the same. They do keep creating new mobile games. Some work, some don't. Let's just say it stays around 35, which is, by the way, as you saw before, 35 is less than it was doing the last 2 years. So let's just say it stays at around 35 for the next 5 years. Then let's look at what let me just think about this. Yeah, okay. So basically there's 2 components of when calculating the intrinsic value of the business. The first one would be the cash flows for the next 5 years. And you have to discount those cash flows back to today's money. Anyone that knows discount cash flow analysis will know this, but if you don't, it's kind of like money in 2023 is worth slightly less than money today because of inflation and all those reasons. Money in 2024 will be worth even less. So all these $35 million in cash, which I expect the business to create, I just have to say, even though that's 35 million in 2027, in today's money, that's only worth 21 million. That's what the second row here is doing.
It's getting the present value of those cash flows.
Yeah, the present value of those cash flows. Okay, so basically, so if we fast forward to 2028, pretend we're all sitting in the year 2028, and my medium case did come true, then what we've earned, like as owners of the business, if we did invest as owners of the business, what we've earned so far is, if you sum up all these, you've earned this much dollars in 2022 dollars, you earned this much, but also you've still got the business. So you need to say, how much is the business worth?
Yeah.
And that's what they call terminal value calculations. So this is where it gets a little bit confusing because so much of the business is tied up in business value is tied up in like cash sitting inside it. So what I did was I broke it into 2 parts. I said, let's say we're in 2028 and because when I bought it, right, like when I bought it in 2022, had about 200 million cash sitting inside it. They've got most of that cash in treasury deposits. So I've used a number here, which is kind of a guess, but I've used 4%. I've just said, let's say those treasury deposits just keep growing at 4% per year, which is, I mean, that's basically what you get right now, right? If you're putting your money in US bonds, if you put it in the bank, you should be getting about that 4%.
Yeah, over the next 5 years, you'd actually probably get more as Jerome Powell looks to raise rates.
Yeah, right. So so I've said, let's say it just keeps rising at 4%. Then we're sitting in 2028. How much cash does the business have in its bank? The calculation shows about 243 million. So in 2028, we've got about 243 million in cash sitting in the bank. Then the other component is business worth. What this is saying is like, let's say we're in 2028 and let's pretend the business does not have any cash in the bank. Like just hypothetically, let's pretend the business has no cash. How much would someone pay for this business just based on what they think the free cash flows are going to be like in the future? So in 2028, they're looking back at this and they're like, okay, like 5 years ago, it made 35. 4 years ago, it made 35. 3 years ago, it made 35. 2 years ago, 35. 1 year ago, 35. So it just keeps making 35. Basically, its earnings are stagnant. Any logical person probably look at that and be like, in the future, it's going to keep going at about 35 million. This business is going to keep earning 35 million per year. So basically, like this is kind of like a bit of guesswork here. But basically, like you can use a PE ratio. You could say like, if someone predicts they've seen the earnings of 35 for the last 5 years, they predict it's going to stay at about 35, they'll probably pay me, and the number I used here was 7. They'll probably pay me about 7 times that number.
I mean, so I think in the public market, they would pay more. I mean, it is a South Korean company, so that you can make it a little bit lower because it is, but for consistent 35 million, a PE ratio of 7 is conservative.
Right, exactly. Yeah. So you're buying a business which is going to keep paying you 35 million for the foreseeable future, and you're only paying 7 times that amount. Yeah, as you say, it could be hopefully a conservative guess. And then basically to work out what the terminal value is, I just added up these two. So you've got the cash in the bank, 243, plus the business worth, which is just like the business side of things, what they would pay for the actual business is 245. If you add those two up, we've got 488 million, which has just zoomed over to there. So 488 million in 2028 is worth about 300 million in today's dollars, right? So if you just basically add up all these numbers, so you add up the cash flows for the next 5 years, plus what I'm going to sell the business for, and we do all of these in today's dollars, the intrinsic value, how much the business should be worth about 435 million.
So for your medium case, the intrinsic value you've calculated is 435 million.
Yes, exactly.
And what do you think is the medium the most likely case?
I think the medium's the most likely, yeah. I think so. It's definitely guesswork, but yeah, I would say probably the medium's the most likely, because I can't see any good reason why the earnings are going to drop off, and I can't see any good reason why they're going to increase drastically. So I think medium's most likely.
Yeah. Well, even I think that is like the medium case is pretty conservative, like 35 million over the next 5 years. Even just 2 years ago or 1 year ago, they were making 55 million. So like that's pretty conservative. But at the end of the day, everyone can make up their own assumptions. This is just your analysis. So if you disagree, then do your own calculation. That's it.
And if this intrinsic value was the case, then basically you'd make about 50% return on what your money was. I think that's true. Yeah, that's about right. Yeah.
Oh, you mean if you paid the current price that it is today?
Yeah, you're paying 280 million, and you would have 435 million back in 2028.
Yeah. So basically what we're doing here is valuing the business as a whole. We're not doing it per share. That we're just doing what Warren Buffett recommends, which is envision as if you're buying the entire business as a whole and then calculate its worth. Guys, this is well, we don't know exactly the method to a T if Warren Buffett's using an Excel spreadsheet, but this is the method that he says he used, which is called the discount cash flow method, and you value the entire business.
Yeah. And yeah, exactly. You can do it by share, but for me, it's more confusing. Other people might like to do it per share, but I just get confused when you're dividing by like you got one really big number, you divide by another really big number. It just adds extra confusion.
Yeah.
I just pretend I own the whole business, and then if the whole business is a good deal, then a piece of the business is a good deal.
Yeah. So you could do the exact same thing and just divide everything by the amount of shares. It'll give you the exact same numbers and everything, the exact same returns. But we've just done the way Warren Buffett recommends anyway. So
yeah. So I just clicked on the bear case spreadsheet. So this is like, again, like we don't know what's going to happen. So I just did 3 cases. I sort of said like, if the most likely thing is going to happen, you can say medium. If the bad thing happens, like basically I want to know what's happening. If a bad thing happens with the business, what's happening to my money? Am I going to lose all my money? What risks am I taking? So I did the same discounted cash flow analysis on the bear case. For this one, I assumed the growth rate for earning is 0.8, which basically means every year we're getting 20% less earnings. So if this year we made 35, then next year, 28, 22, 17, 14, 11. So the earnings would be dropping off. Like, again, yeah, this is the bear case. I actually can't see any reason why this would happen, but it could happen. And if it could happen, I would like to know what's happening with my money. So if this does happen, again, we can do what we did before. We fast forward ourselves through to the year 2028. And we say, all right, we're sitting in the year 2028. This is what the earnings look like for the past 5 years. What is the business worth now? Again, the cash worth is going to be the same because they've got the money sitting in the bank. The money sitting in the bank is going to just keep going up at 4%. It's what cash does. It's going to be worth 243 million. That's safe. The bit that's going to change in this bear case is the business worth, because now, again, we'll do the same thing. We'll pretend there's no cash in the business, and we're going to say, if there's no cash in the business, what would someone pay just for the business side of things? And now they're going to look at it and they're going to be like, wow, okay, 5 years ago making 28, then it made 22. Last year it made 11. They're going to be like, oh, this business is pretty bad. Like, obviously the earnings are dropping off. So we gave a PE ratio of 2. PE ratio of 2. Basically, I mean, that is actually probably still quite conservative. Have you seen a business with a PE ratio of 2 before?
yeah, I mean, that's generally that's only when earnings go crazy for 1 year and everyone expects it to go.
Oh,
It's
okay.
an erratic year where they have a crazy year.
What about for a company that's sort of dying, like this one would be?
Nah, it'd be more than 2.
Probably. So it's very conservative, like a PE ratio
It'd be
of 2.
way more than 2.
So basically, we assume in this case, someone's going to pay 22 mil for the business side of things. Again, we add up what the cash in the bank plus the business worth. This time we left with 266 million. So again, like what the intrinsic value would be today would be add up all the cash flows over the next 5 years, what it's going to make, plus what it's going to sell for, and plus what we think we could sell the business for in 2028. And if we convert all those dollars back to 2022 dollars, we end up with this number here, which is 239 million. And right, as you saw earlier, like the market cap is 280 million. So we're paying 280 million for the business. And in the bad case scenario, it's worth 240 million in today's dollars. So yeah, in the bad case scenario, you are losing money basically. You're losing money, assuming, and this is where it is, but you're losing money assuming that if you took that money, you could put it somewhere else and gain 10%. So that's what that 10% discount rate means. It means like, I think I could take this money and put it somewhere else and for certain get 10% back, which again
Yeah.
is another very conservative assumption.
Yeah.
It would be quite hard to do that.
So in the worst case, let's say you did pay 280 million, you'd get like a 6% return maybe.
Probably, yeah. If you change
But,
this number, you can have a look at what the return might be.
yeah. Oh, there, boom.
Yeah,
Yeah, I think we did that earlier.
so 6%, yeah.
The worst case, according to your analysis, is 6% return.
Yeah. And then obviously there are worst cases, to be fair.
Yeah. There's always.
It's a scam, let's say.
But it's not a scam though. You can't say
yeah, I'm just, no, I know. I'm just saying like worst case.
Yeah.
I don't yeah. Again, I
mean, you can go in depth into all of these different things,
yeah,
but
true.
you got to be somewhat like rational what might happen. True. Like it's been around for 20 years. They've sold so many games. They've made all of this income for so long. Like it's not a scam.
True. So we'll just go through the bull case quickly. And again, you're probably all getting the hang of it now, so I don't have to spend too long. But for this one,
and for the people who don't, they just have to just do a bit of study, probably a decent amount of study on the way Warren Buffett discounts stocks and calculates the value of stocks, and you'll get used to what it's just like a couple of key terms that you need to get your head around. But some of you would have already done it and you'll understand exactly what he's saying. If you don't understand exactly what he's saying, you just got to do a bit of study on discount cash flow and just learn a few terms.
Yeah, this is the most important thing you can learn for value investing is discounted cash flow analysis. If you can't do this, you don't really have a way to value what stocks should be.
Yeah,
like that's putting it like the most blank way. You have to be able to do this basically.
Yeah, so just spend a week or whatever just studying in depth how it all works. And once you know, it's really fun and it's really important because you can actually like learn the value, get the feel for the value of a stock, and you can be different to most people who know the price of everything but the value of nothing, which is what the definition of a fool is.
Well put. And once you know the value of stocks, you know when you're getting ripped off, right? You know when it's a really bad deal, which most people don't. You know what? It actually that's one of the main things that stops you or stopped me looking at doing the whole number go up. If number go up, it must be good stock. If number go down, it must be bad. Like looking at being able to do this helped me see it like differently. Yeah. Now I see it as like, am I getting a good deal or not?
Yeah, it's the value investing approach. That's the way he does it. There are some investors who purely look at price and actually make money. Most don't. Mostly it's the market, but there are some who do different trading strategies and different things. And that's a different like style of investing.
Yeah.
And but you're a value investor. So this is the way you do things like Warren Buffett.
Yep. So let's have a quick look at this bull case. So now I'm assuming for the bull case it's growing at 20% per year, which means next year it makes 42 mil, then 2024, 50 mil, then 60 mil, 72 mil, 80 mil. It's almost 90 mil actually. Is not actually that crazy because 60 mil is actually what it made. If you have a look, 60 mil is what it made. If it made 63 mil free cash flow a couple of years ago. So it's just saying it's basically going to get back up to where it was. And if this bull case is correct, the numbers actually look quite crazy because, again, fast forward to 2028, the cash worth is still going to be the same. So we have the cash in the bank in treasuries. But now the business worth looks really good because someone who's looking at this business, pretending it doesn't have cash in the bank, someone who's looking at the business and they're looking at what the earnings have been over the last 5 years, they're going to look at this and be like, wow, those earnings have been increasing quite drastically. And because those earnings have been increasing at that rate, I'm probably going to pay them a decent PE ratio. The number I used for this was 20, a PE ratio of 20, which what do you think? Does that kind of fits in with what's conservative for what the market's valuing now, right?
Yeah, I mean, come on, a business growing at 20% in earnings every year. I mean, and a PE ratio, that is very conservative. To put a 20 PE ratio on a business growing 20% in those earnings every year.
Like what was App? Do you know what Apple is now or any of those companies?
I mean, I believe right now, at the time of making this video, the average P ratio across all of the stocks in the stock market is around 20, 21, maybe even a bit more. And most stocks are not growing at 20% earnings per year. So,
Wow. So then 20 is very conservative.
yeah.
And if that is the case, you just take this 87 million, which is most recent earnings, and you times it by the P ratio of 20. And the business worth in 2028 in this bull case would be looking at $1.7 billion.
Yeah.
And if you add up the cash in the bank plus the business worth, you get 1.9 billion, almost $2 billion
Yeah.
in 2028. That's how much we could sell it for. And then again, discounting the cash we're going to make between now and then, plus the amount we're going to sell it for, if you discount them all back to today's dollars, you end up with about 1.4 billion is what the intrinsic value of the business would be worth.
Mm. So if you compare that to price, 280 million, that's a multi-bagger, 6 times probably around there.
Mm-hmm.
And that's the bull case. Even you could argue that bull case is, there's a bull case that could be a whole lot more than that. 2025, they're going back to the same earnings that they were in 2020. That's your bull case.
Yep,
I mean,
exactly.
so yeah,
Conservative bull case, it really is.
I'd say so. Pretty conservative.
I mean, there you're getting a mad deal. There you're getting like, I don't know, 4 or 5 times your money.
Yeah, like a multi-bagger type approach.
Yeah. Yeah.
For
Pretty
Bryce
good.
style. So we talked about this earlier, but we're talking about Monish Prabrai and how his style is heads, I win, tails, I don't lose much. It's kind of like the same with the stock. Heads, bull case, or medium case, you win, you make decent amount of money. Worst case scenario, you lose a tiny bit of money. I don't lose much.
Assuming you have another investment in mind where you could definitely get 10%.
10%, yeah.
If you don't have another investment in mind, let's say, as we said before, if the best investment you think you could do is 6%, then actually you don't lose any money.
In the bear case is actually fair price.
Yeah, it is.
Yeah.
So it would be good to hear what people's feedback is on this actually.
Yeah.
See what they think, yeah.
See if they can spot any holes in the analysis, any holes in the balance sheet, income statement, future cash flow, etc. Terrible management or something, unethical management.
Yeah.
Generally, with unethical management, you don't see them being conservative and holding all of this cash and getting into hardly any debt and doing this with their balance sheet. Normally, the red flags with management, they're often getting into a lot of debt and stuff like that.
Yeah, no leverage in this as well. No leverage, not much debt.
Like Sam Bankman-Fried, right? He got in a crud load of debt, leverage. So these are clues to see how the management is.
Yeah. So it would be good. It would be really good having people look through it for themselves and maybe let us know in the comments or something.
Yeah, I'd love to see that. Get some people in the comment section, do their own analysis and see what they come to, and see if we can all bounce off one another and get a deeper picture for the stock. But we should probably disclaim that you do own the stock now. You bought it at the start of the year.
Yes. Yeah. I bought the stock. I'm still buying slowly, just and deep. What do they call it?
Accumulating DCF, DCA.
When you put cash in like over a period of time, I can't remember now.
DCA, dollar cost average.
Yeah, that's it.
Yeah. Yeah. So guys, do your own analysis. Tell us what you think. What would Warren Buffett think of the stock? What do you think? Do you have an intrinsic value of the stock, etc.? What do you think of the business model? A great thing will be some person who loves or just plays the game itself and the different games and spin-offs. They'll have a really good idea of how it's going to do in the future. So is there anything else we need to discuss with the stock? I mean,
I can't think of anything actually.
Yeah.
Unless you got any more questions apart from that.
I think we'll leave it to the viewers to make up their own minds and let us know what they think.
or even look for holes in my
Yeah.
analysis. Yeah, that'd be good.